Welcome to The Explainer. You ever feel like investing in the stock market is kind of like gambling? You buy a stock, you cross your fingers, and you just hope for the best? Well, you're not alone. But today, we're going to change all that. We are going to build a complete professional-grade system that takes the guesswork out of investing and puts you firmly in control.
And this quote right here, it just absolutely nails the core problem. For so many people, this is the entire strategy. Buy something and hope. But listen, hope is not a strategy. It's a mindset that leaves you totally powerless, like you're just a passenger on a roller coaster you can't even steer. Honestly, that approach is a lot closer to a Vegas casino than it is to professional investing. Today, we're going to completely flip that mindset on its head.
So, here it is, the big shift we're making today, moving from being a speculator to becoming a true investor. See, a speculator is playing a one-way game. They need that stock to go up to win. That's it. An investor, though, is playing a totally different, multi-dimensional game. They have a system. They have a plan for what to do if the stock goes up, if it goes down, or even if it just goes sideways. That's the kind of strategic framework we're building right now.
All right, so here's our roadmap for today. We're building our entire system on 4 solid pillars. First, fundamental analysis. That's going to tell us what to buy. Second, technical analysis for when to buy. Third, generating cash flow, which helps us to find why we're buying in the first place. And finally, and maybe most importantly, managing risk, which is all about how we survive. Let's dive in.
Okay, let's start with our foundation. Pillar number 1, fundamental analysis. This is all about answering one simple but really deep question. Is this a good company? It's all about figuring out the real, actual strength and value of a business, completely separate from whatever its stock price is doing on any given day. So, what does that really mean in practice? Well, think of yourself as a detective for businesses. Seriously, you're not just looking at the shiny new product or the cool marketing, you're popping the hood and you are checking the engine. We're going to dive deep into the financial statements to see if the company is genuinely solid, if it's profitable, if it's growing, no matter what the daily market noise is shouting at us. And the heart of all this detective work is the financial statement. And you know what? It really boils down to these 3 key things. You've got assets, that's everything the company owns that can generate value. You've got liabilities, that's everything the company owes. And when you subtract what it owes from what it owns, you get its equity, its true bottom line net worth. The core idea here is so simple. We want to find companies where the assets are consistently growing faster than the liabilities. That's it.
And let's look at a real-world example here. At the end of 2010, Apple had $86 billion in assets. Now, that's not just some impressive number on a page. That was a massive war chest of resources they could use to innovate, to grow, and to dominate. And boy, did they grow. That one single number was a huge clue, a fundamental indicator of the incredible decade of growth that was about to happen for that company. A real investor would see this and dig even deeper, confirming that this financial strength was real and not just built on a mountain of debt.
And this quote from Warren Buffett, it just brilliantly sums up the entire goal of fundamental analysis. The price is that sticker on the stock that's changing every single second, driven by fear and by greed. But the value is what the business is actually worth based on its real-world performance. Our whole goal as a fundamental investor is to find those incredible moments where the value you get is way, way higher than the price you have to pay.
You know, the master of this stuff, Warren Buffett, has a really simple but incredibly powerful 4-part test. He won't even look at a company unless 1, he understands it, 2, he believes it has a real long-term future, 3, he trusts the people running the show, and 4, he can buy at a discount to its real value. It's a simple but brutally effective system that has stood the test of time.
Okay, so you've done your homework. You've found a fantastic company, and it looks like it's selling at a fair price. But that's only half the battle, right? Now you have to decide, is this the right moment to buy? And that, my friends, is where our second pillar, technical analysis, comes into play. So, while fundamental analysis looks at the business itself, technical analysis looks at the stock. And, more importantly, the people who are trading it. Think of it like this. Your fundamental analysis tells you which car to buy for your big road trip, but technical analysis is you checking the weather and the traffic before you pull out of the driveway. It's all about reading the psychology of the market, right there on the charts.
The most basic and honestly the most important story a chart can tell you is the trend. In a nice, clear uptrend, you see this beautiful pattern of higher highs and higher lows. Each peak is higher than the last one, and each valley is higher than the last one. It's just a clear visual sign that the buyers aren't controlled and they are pushing that price higher. You want to swim with that current, not against it.
And on the flip side, you have the downtrend, a pattern of lower highs and lower lows. This is a big red flag that the sellers are in control. So even if you absolutely love a company's fundamentals, buying during a strong downtrend is like trying to swim up a waterfall. It's just not a good idea. Technical analysis tells you to just be patient. Wait for the tide to start moving back in your favor.
All right, this next pillar, this one represents a massive mindset shift from most people. We've talked about what to buy and when to buy, but now we need to get crystal clear on why we're even making this investment. What is its actual purpose?
Now this is a game-changing idea right here. What if you could get paid just for the passage of time, whether the stock price goes up, down, or sideways? It's totally possible. Instead of just betting on a stock going up, you can actually structure your investments to generate a steady stream of income. It's a completely different way of looking at the whole game. And this real estate analogy just makes it so clear. Think about it. Are you flipping a house, just hoping to sell it for a quick profit? That's a capital gain. Or are you buying a rental property to collect a steady stream of rent checks every single month? That's cash flow. Both can work, for sure, but a cash flow strategy means you get paid while you own the asset, not just if you manage to sell it.
So before you ever place a trade, you have to decide what your objective is. Are you here for a capital gain? You know, the classic buy low, sell high? Or is your goal to generate consistent cash flow, maybe using dividends or simple option strategies, like basically renting out your shares to someone else for a fee? Or are you maybe using this trade as a hedge, like a form of insurance to protect something else you own? Your answer to that question is absolutely critical. It dictates everything else.
And here we are. We've arrived at our final and, you could argue, our most important pillar. Look, anyone can get lucky and pick a winning stock once in a while. But professional investors stay in the game for decades because they have a clear, unemotional plan for when things inevitably go wrong. This is the pillar of survival, risk management.
See, smart investors don't just hope for the best, they actively plan for the worst. They use a whole toolbox of strategies. Things like position sizing, maybe never risking more than, say, 2% of their account on any single trade, or using stop-loss orders to automatically cut their losses if they're wrong. These aren't just suggestions, they are essential, non-negotiable tools for long-term survival in the market. This is your defense, and defense wins championships. And this right here, this brilliantly illustrates the secret to long-term profitability. You do not have to be right all the time. Just look at this. If you're right only half the time, but your wins are the same size as your losses, you go absolutely nowhere. You break even. But look at that second line. If you structure your trades so your wins are just double your losses, you can be wrong half the time and still come out significantly ahead. It's not about predicting the future, it's about managing the math.
Okay, we did it. We've built all 4 pillars. Now let's put them all together into one single cohesive system. And honestly, the best way to think about this is like a pilot's pre-flight checklist. It's a simple, repeatable process you have to go through before any investment is allowed to take off. And here it is. Before you invest a single dollar of your hard-earned money, you must be able to confidently answer these 4 questions. Number 1, fundamentals. Is this a business I actually want to own? Number 2, technicals. Is the market's momentum on my side right now? Number 3, cash flow. What specifically am I trying to accomplish with this trade? And number 4, risk. What is my exact plan to get out if I'm wrong, and how much am I willing to lose? If you can't clearly answer all 4 of those, the decision is simple. You don't make the investment. You just wait.
And ultimately, this is what it all comes down to. The market is always going to be there, flashing prices at you every second, tempting you to do something, anything. A speculator chases those prices. But a true investor, armed with a system just like the one we've built today, has the discipline and the patience to just ignore all that noise and wait for real, genuine value to show up. This system is your tool to find it.